Usually, the American employment or non-farm payrolls figures hog the first week of a new month, and sure enough, on Friday the 4th of December, economists will be looking to see how many new jobs America created last month, in comparison to October's 638,000. But on this occasion, even those important numbers could be overshadowed by the 180th meeting of OPEC, the Organisation for the Petroleum Exporting Companies, which turns 60 years old this year. Usually, the 13-member grouping meets in Vienna, but on this occasion the event will take place remotely, owing to the pandemic. Oil, as benchmarked by Europe's Brent crude, has bounced back from the chaos of spring when the price of a barrel briefly went negative as demand collapsed due to the pandemic and there was so much of the stuff sloshing around that no one knew where to put or store it. Since then, some degree of calm has returned to the market and Brent crude has climbed steadily through the summer and autumn to $46 a barrel, although that is still a quarter below where it was a year ago. This recovery, tentative as it may be, is being fueled by hopes for a vaccine and a return to more normal levels of economic activity in 2021, a drop in US shale output as producers there falter in the face of weak oil and gas prices, capital investment disciplining amongst major oil groups, and also the production cut agreement brokered by OPEC and Russia back in April, which cut output by some 9.7 million barrels a day, or almost 10% of global daily supply. And that's why this latest OPEC meeting is so important. According to OPEC's 2020 World Oil Outlook document, global oil demand will rebound by some 6 million barrels a day in 2021 to 96.3 million barrels, while demand in 2022 is seen exceeding the pre-pandemic peak of 2019, though that does assume the pandemic is under control by then. Now, such a rosy scenario may give OPEC and Russia some leeway to coax production higher, although they may want to do so carefully to support oil prices given uncertainties over the pandemic and the global economy, as well as the ongoing drive away from hydrocarbons and toward more renewable sources of power. Back home, we have a select number of large, mid and small cap companies that are due to publish results or a trading statement or host an annual general meeting for shareholders in the coming week. Firms which may be worthy of note because of what they have to say about their own business or industry or even the wider economy include the following, although do note that some of these dates may be subject to change. Retailer Tops Tiles on Tuesday the 1st of December. Avon Rubber, as I record this, the single best performing stock in the FTSE 350 over the past decade, is due on the 2nd. Transport specialist Go Ahead Group in Paragon Banking on the 3rd, before the week closes out with travel agent TUI on Friday the 4th of December. But the company which is perhaps most likely to cause a fuss in the week ahead is high-end FTSE 100 house builder Berkeley Group, which is set to publish its first half results on Friday the 4th of December. Sadly, this will be the company's first formal results statement since the untimely death in the summer of chairman, co-founder and building industry giant Tony Pidgley. Berkeley shares are, at the time of recording, trading at the highest level since March, although they're still down by a fifth from their early 2020 peaks. I guess the share price slide owes much to the pandemic and prevailing economic uncertainty, despite government initiatives to support the house building industry, which include the latest extension of the Help to Buy scheme and a holiday on stamp duty land tax on the first £500,000 cost of the purchase of a property, and that runs until the 31st of March next year. However, Berkeley's September trading statement did offer some grounds for encouragement and support to the share price recovery that's been seen since the height of the market-wide panic in March. Berkeley reaffirmed its guidance for both full-year profits and its capital return plans. In terms of profit, Berkeley still expects to make £500 million pre-tax in the year to April 2021. That's broadly flat on the prior year, although the split between the first and the second halves is now expected to be more equal than previously. In the first half last year, for the record, Berkeley made £277 million pre-tax. Meanwhile, Berkeley stuck to its plan to return £280 million to shareholders each and every year in cash through to September 2025. The £140 million return in the first 6 months of the fiscal year came in the form of a 107 pence a share dividend, worth £134 million, with the rest coming in buybacks. Analysts and investors will look for any guidance on the possible mix between dividends and share buybacks going forwards, and also whether the firm will revive its plan to hand over a further £455 million in cash to shareholders. That additional scheme was put on hold when the pandemic hit, but if it is revived, then between now and September 2025, Berkeley could return almost £2 billion to investors in cash and dividends, and that compares to a current market cap of £6 billion. As a final point, analysts will no doubt look for comments on volumes, pricing and order books, as well as Berkeley's views on the housing market and its main areas of activity, which are London, the South East and Birmingham. Last financial year, Berkeley sold 2,723 houses with an average selling price of £677,000, while the order book stood at around £1.8 billion at the time of the September trading update, broadly unchanged from the prior financial year. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.